What if I told you that most investors are chasing the wrong things?
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
While everyone scrambles for the next hot stock tip, the world's most successful investor has been following the same timeless principles over 60 years. In this video, I'm breaking down Warren Buffett's timeless investing lessons that helped him amass a fortune of over $160 billion. And these are principles that work regardless of market conditions. And these aren't complicated strategies either. They're surprisingly simple approaches that anyone can use and most people overlook in their rush for quick profits. Have you ever wondered why 90% of new investors lose money in their first year? The numbers are staggering and they reveal a painful truth about the investing world that few people talk about. You see, most people jump into the stock market with dreams of quick riches, but end up with depleted accounts and crushed confidence instead. And this is because the truth is that most beginners enter the market with completely unrealistic expectations. They chase quick profits and hot stock tips from friends, coworkers, or social media accounts promising overnight wealth, and they hear stories about someone making a fortune on Tesla or Bitcoin in just months, and suddenly they're throwing money at investments they don't even understand. And this approach creates a perfect storm of financial mistakes because when the market drops 2% in a day, these new investors panic. When everyone's talking about a trendy stock, they buy at peak prices without checking if the company even makes money. And when emotions run high, they make decisions that permanently damage their long-term wealth potential. And research shows that the average new investor underperforms the market by 4 to 6% annually. And that might not sound like much, but it translates to thousands of dollars lost over just a few years. And over decades, we're talking about hundreds of thousands of dollars in missed gains. And this performance gap isn't just disappointing, it's financially devastating. Consider what happened during the recent meme stock frenzy. Countless beginners poured their savings into companies like GameStop and AMC based on Reddit posts and Twitter trends, and many bought near the peak, watching in horror as their investments crashed 70% or more within weeks, because they bought based on social momentum rather than business fundamentals and paid a steep price for that lesson. And the same story played out in the crypto market when Bitcoin approached 65,000. Social media gurus with zero credentials convinced thousands of new investors to buy in right before it plummeted below $20,000. And these weren't isolated incidents, they represent psychological traps, although that particular trade would have worked out well in the long run, which is why holding through volatility on high conviction plays, otherwise stated assets that you understand and believe in, can allow you to create long-term profits regardless of day-to-day market volatility. And these traps follow a predictable pattern. You see, fear makes you sell during market drops when you should be buying, and greed pushes you to chase already skyrocketing stocks when you should be cautious, and information overload paralyzes you with conflicting advice until you make impulsive decisions out of frustration. And the financial media makes everything worse. You see, news channels need constant drama to keep viewers engaged. Markets in turmoil specials air every time stocks drop over 3%, creating unnecessary anxiety, and investment websites publish contradictory headlines like 5 stocks to buy now and market crash imminent on the exact same day. And this environment breeds nothing more than FOMO and pushes new investors into terrible decisions based on short-term noise. But what if there was a proven approach that has worked through every market crash, recession, and bubble for over 60 years? An investing method that doesn't require genius-level intelligence or insider connections. You see, this isn't speculation, it's exactly what Warren Buffett has done to become one of the richest people on earth. And Buffett's #1 secret that most people miss is investing in what you understand, not what's trendy and not what's complicated. While most investors chase complex tech stocks that they can't explain, Buffett buys companies with products and services that he comprehends completely. He famously avoided the entire dot-com bubble because he couldn't clearly explain how many internet companies would make sustainable profits. That decision saved him billions in losses when the bubble finally burst. And this principle seems almost too simple, but it's incredibly powerful. You see, when you understand a business, meaning how it makes money, who its customers are, and what its competitive advantages are, you make more rational decisions during market volatility. Because if you understand the business, you know whether a 20% price drop represents a real problem or a potential buying opportunity. Understanding the business is just the first step. Let's look at how Buffett evaluates whether a good business is actually a good investment, because that distinction has made all the difference in his phenomenal track record. So what's the difference between a good company and a good investment? And this confusion costs investors thousands of dollars. You might love shopping at Apple stores or drinking Starbucks coffee, but that doesn't automatically make their stock a good buy at any price. And this is where Buffett's value investing approach comes in. While most investors get distracted by flashy growth numbers and exciting product announcements, announcements, value investing looks beyond the hype to find companies trading below their actual worth. It's like finding a $100 bill that's selling for $70, and who wouldn't want that deal? Because here's what really separates Warren Buffett from average investors. While everyone chases the same popular overpriced stocks that financial media can't stop talking about, he hunts for solid businesses with strong fundamentals that Wall Street has overlooked or undervalued. He's perfectly content buying boring companies if the price is right, which is why his portfolio includes things like insurance companies, banks, and consumer goods, not exciting tech stocks. Buffett examines specific financial metrics that reveal a company's true health. He looks for consistent earnings growth over many years, not just one good quarter. He avoids companies with high debt to equity ratios because excessive debt becomes dangerous during economic downturns. And he prioritizes businesses with high ROE or return on equity, which shows how efficiently a company uses shareholders' money to generate profits. And when Warren Buffett reads financial statements, he focuses on something most investors ignore: free cash flow. While accounting profits can be manipulated with various tricks and one-time items, cash flow shows the actual money that a business generates, and this approach helps him spot potential problems that glossy annual reports try to hide. He's searching for companies that consistently produce more cash than they need to operate, creating a surplus that can fund growth or be returned to shareholders. And this concept of an economic moat is central to Buffett's strategy, because just as medieval castles used water-filled moats for protection, businesses need competitive advantages that protect their profits from competitors. You see, Warren Buffett only invests in companies with sustainable advantages like strong branding, which is the case of Coca-Cola, or high switching costs, which is in the case of American Express, or network effects, which is evident in the case of Apple. Without a moat, competitors will eventually erode a company's profits, no matter how good its current results look. And let's consider Warren Buffett's investment in American Express back in 1964. After the salad oil scandal caused Amex stock to plummet, Buffett saw an opportunity where others saw disaster. He recognized that the company's core credit card business remained strong despite the crisis, and so he invested $13 million, which was a massive amount of money at that time. And today that stake is worth billions, proving the power of identifying quality businesses during temporary market panic. And patience forms another cornerstone of Buffett's approach. You see, he purchased Coca-Cola stock in 1988 for $1.3 billion and has held it through multiple market crashes, recessions, and periods of underperformance. But that investment has grown to over $25 billion in value today, showcasing the power of long-term thinking over constant trading. And perhaps most importantly, Buffett demands at least a 25% margin of safety before buying any stock. This means he only purchases when a company is trading at least below 25% of his calculation of its intrinsic value. And this buffer protects against mistakes in his analysis and gives him significant upside potential. It's like insisting on paying no more than $75,000 for a house you've determined is worth $100,000. And the truth is that this is what a lot of seasoned real estate investors do already, because the truth about making money when it comes to investments is that a dollar saved is a dollar earned. But even with the right strategy, market crashes and downturns test every investor's resolve. The real question is, how does Warren Buffett handle market volatility when most investors panic and make terrible decisions? You see, his approach during these critical moments reveals perhaps his most valuable lesson of all. And this begs the question, why do even experienced investors panic sell during market crashes? The answer comes down to a fundamental truth about our brains that Buffett has mastered while most of us still struggle with it. When markets plummet, we're not just worried about money, our brains are actually triggering the same primal fear response that evolved to protect us from physical threats. And this biological reaction explains why smart, rational people make terrible financial decisions during downturns. When stock prices fall sharply, your brain doesn't see numbers on a screen, it senses danger. Your heart rate increases, stress hormones flood your system, and your thinking narrows to focus on immediate threats rather than your long-term plans. And the consequences of this fear response are enormous. During the 2008 financial crisis, investors pulled billions from the market at precisely the worst moment, right before the recovery that would have repaired their portfolios and created substantial wealth. These weren't just novice investors making these mistakes. Experienced investors and even hedge fund managers fell victim to the same panic response, selling quality assets at fire sale prices. And this is where Buffett's contrarian mindset creates his biggest advantage. While others flee the market during crashes, he follows his famous principle: be fearful when others are greedy, and greedy when others are fearful. And this isn't just a clever saying, it's the foundation of his approach to market volatility. Consider Buffett's actions during major market collapses. For example, in 2008, as the financial system teetered on the edge, he invested $5 billion in Goldman Sachs when most investors questioned whether the bank would even survive. And during the 2020 COVID crash, while others worried about the end of the economy, Buffett's Berkshire Hathaway quietly accumulated shares in quality businesses trading at discounted prices. You see, Buffett views market crashes not as disasters, but as rare opportunities that might appear only a few times in an investor's lifetime. He understands that market fear creates temporary discounts on quality businesses, essentially putting stocks on sale for patient investors. And he's famously quoted saying that the stock market is the only place where everyone freaks out when everything goes on sale. And the math behind this approach is compelling. Buying quality companies at 30 to 40% off can generate exceptional returns when markets eventually stabilize. Panic selling also destroys one of investing's most powerful forces, which is compounding interest, because a $10,000 investment growing at 10% annually becomes $67,000 after 20 years, but only if you stay invested. Missing just the 10 best market days, which often occur during volatile periods, can cut your returns in half. And timing the market perfectly is virtually impossible even for professionals. And I've even learned this the hard way. You see, Buffett's information diet plays a crucial role in maintaining his emotional discipline, because while most investors obsessively check stock prices and consume anxiety-producing financial news, Buffett spends hours reading annual reports in business publications that focus on company fundamentals. He famously avoids financial TV shows that create urgency and short-term thinking, allowing him to make decisions based on business facts rather than market emotions. And another key component of Buffett's approach is maintaining substantial cash reserves. Berkshire Hathaway typically holds billions in cash, not because Buffett fears market crashes, but because he welcomes them. The beauty is that this cash position lets him act decisively when everyone else is frozen by fear, picking up quality assets at bargain prices. And during market drops, while average investors panic sell their stocks, Buffett increases his buying, focusing specifically on companies with strong balance sheets that can weather economic storms. He knows these businesses will survive tough times and emerge stronger when market conditions improve, making them ideal investments during periods of extreme pessimism. And these principles have helped Buffett outperform the market for decades, generating wealth that has made him one of the richest people in the world. But how can you apply these same principles starting today without billions in capital or decades of investing experience? For starters, you can make an investment in hitting the like button if you're enjoying this content and subscribing to the channel for more timeless investing principles and macroeconomic news. But seriously, the real power of Buffett's approach isn't in complex stock formulas, but in the consistency to follow straightforward principles when everyone else is losing their minds. You don't need a finance degree to use these lessons, just the patience to buy quality businesses at fair prices and the courage to hold them through market chaos. The most important insight from Buffett's career might be that investing success comes from temperament as much as it comes from intelligence. The question isn't if you can pick winning stocks tomorrow, it's if you can follow a proven strategy for decades.